We are Highwoods Properties. We're headquartered in Raleigh, North Carolina. We're an office REIT. We have about 28 million square feet of owned properties. Our strategy is to locate in what we call the best business districts within the Sun Belt. So we believe that generates good long-term rent growth and good demand for our properties. We also are a pretty active capital recycler. So we acquire assets, we sell assets, and we develop. And we think in the office business, being an active capital recycler enhances long-term returns as we harvest value from assets where we believe the risk-adjusted returns are going to be lower over time, and recycle that capital into assets where we think there's better long-term growth prospects and better risk-adjusted returns. So we were founded in 1978 here in Raleigh, North Carolina, and then we went public in 1994 at the advent of kind of the modern REIT era, when a lot of the current REITs went public in the early and mid 90s. The reason we went public was to grow beyond our roots in Raleigh throughout the Southeast. And we went public. We had about a $250 million market cap. We quickly expanded and grew to over $1 billion. Being public gave us access to capital, so that allowed us to expand. I think the other benefit of being public is that we are an infinite life vehicle. Therefore, we're not forced to return capital to shareholders by selling assets at points when it may be an inopportune time to sell assets. So we like the infinite life vehicle aspect of being a public REIT. The other thing that we think is beneficial to us in the public REIT structure is we believe that it imparts discipline on capital allocation. As a REIT, we distribute a lot of our income and pay a dividend. We pay $2 a share, so it's currently around 7%. So we distribute a lot of our cash flow back to shareholders in the form of dividend. And therefore, if we want to grow, there's two primary ways that we do that. Either what I mentioned earlier is we could sell assets, or we could ask investors for new capital. And I think because we often will raise capital, we need to make sure that both our past capital allocation decisions and what we communicate as what we're going to use capital for have good risk-adjusted returns. And we like that discipline because we've got to ask investors oftentimes for capital to be able to grow. And so we need to make sure that we're doing a good job to continue to have confidence of our investors, both on the equity and fixed income side, to continue to support us and provide us capital and give us good access to capital. So there are a couple of things. So we think within our markets, within the Sun Belt, we're in the cities where the demographic trends are above national average, both in terms of population growth and job growth. We're in markets that we describe as kind of business friendly. So we often see a lot of corporations relocating their headquarters or putting big regional offices there. So we think that has a benefit to our markets. The other thing that I would say is across the commercial real estate landscape, office is an out of sector favor right now in terms of capital deployment. And what that has done over the past several years has limited the level of new supply. At the same time, we have seen demand for our space continue to hold up well, particularly for high quality office buildings within the BBDs where we operate. What that does is that has created a dynamic where we're starting to see rent spikes because there are limited high quality blocks of office space available, particularly for well-capitalized landlords. But there's still good demand for that space. So we're starting to see rent spikes in a few of our markets, I would say Dallas and Charlotte in particular. We think that those are going to expand to a number of other markets and submarkets where we operate. And so we think over the next several years, given the lack of new supply and good demand that we have, that we're going to see good rent growth and outsized rent growth across the majority of our portfolio. And we think that'll be a good opportunity for us to drive rents higher. And then at the same time, because there's less interest in office space, we believe investing in new properties, we're able to get good risk-adjusted returns, and believe that those two dynamics will allow us to grow at an above-average clip over the next several years. I think the biggest narrative right now in terms of the reason why office is probably out of favor, I think we've moved beyond the immediate post-COVID concerns about work from home. There's some of that, and there's probably a little bit of demand destruction that occurred attributable to hybrid work or work from home. But that has generally stabilized, and what we've seen is leasing demand across our portfolio has been fairly steady over the past several years. And now there's concern that the proliferation and adoption of AI tools is going to create some long-term white-collar job destruction, which therefore will lead to less office-using jobs and less demand for office. So that is probably the biggest kind of narrative that we have that's concern. And then I would say there's probably even a little bit more of a specific concern across Sunbelt markets, where some people feel like we are more disproportionately exposed to administrative job functions compared to some of the gateway cities where there may be more front office using jobs. A couple of things. One, we think that there's probably likely to be some level of demand destruction and office using jobs destruction through the proliferation of AI tools and the adoption of those tools. But we don't think that it's going to be so significant that it's going to lead to a significant reduction in net absorption for the highest quality office space within our footprint. The second thing is related to administrative or kind of back office jobs. There certainly are some of those within our markets. There are also those within the markets in gateway markets, but where we're located, the folks who are in our offices and in the offices that we generally compete against, those are largely front office facing jobs that are there. So I use this description in meetings that I have with folks. I mean, B of A is our largest, they're our largest customer, they're our biggest customer in our portfolio. All of my bankers for B of A are in our building in Charlotte. So, and it's the same thing with JP Morgan, and it's the same thing with the lawyers that we use across our footprint as well. So we generally have very limited back office use across our 28 million square foot portfolio. Yeah, so beyond what I mentioned in terms of just like what we like our geographic footprint, let's just keep it like very high level. What my kind of quick pitch to folks when they're just thinking about, you know what, like I'd like a good investment. We pay a 7% dividend yield. We've got good cash flow to support that level. And we have grown at about a 3% compounded clip over time. So we have low leverage, and we believe that without any yield compression or multiple expansion, you can get a 10% annual return over time. So it's kind of what we call a get rich slowly scheme, where you're able to just compound that returns over time. And we think that our valuation is low currently, and there's upside potential to that. But to get a 10% total return, we don't need any improvement in valuation. We just need to, we can kind of hold at current levels, and you ought to be able to get that kind of return. So if you get 10% compounded return over time, we think that that's a good risk-adjusted return for a vehicle like ours.